So I'm going to jump into the next topic and then conclude so we can have a brief discussion and answer any further questions. So the last life's persistent question that I'm going to cover is, can we make life insurance the income replacement solution it's meant to be? And I say meant to be because income replacement is by far the largest component of the life insurance needs calculation. And in our base model, before we subtract out resources, it represents 3/4 of the amount. We also recommend this income multiple without even explaining why we pick 7 or 10 years. I always thought that was kind of an implicit assumption that, you know, it's just enough time for the survivors to kind of get on their own financial feet. Someone else I know thinks it gives someone enough time to remarry. But also income needs, as we said, change significantly over time, yet we sell people rectangles, right? So on the bottom left is the anatomy of a life insurance policy. It happens to be my prior policy, which I terminated this spring because it reached the end of the term period and the premiums went up by 30 times the original premium. But we sell rectangles, right? So we buy a coverage amount and that coverage amount stays level for the period of the policy, whether that is a term policy or permanent. Other than some permanent policies, obviously, can increase over time. But the amount quickly gets divorced from the underlying need. Beyond that, current approaches, I believe, have significant double counting in them. So the question about debt repayment, I think, was a great question, because if we're including income replacement in these policies, isn't that income already currently being used to pay for debt, to put money aside for college, retirement, and other things? Yet we add those in as additional amounts into our calculations, and I think that's double counting. And there's a way to actually kind of simplify a lot of this, and that is to make life insurance an income replacement solution by paying the benefits as an income, not a lump sum. And this is from my policy. So it says a death benefit will be paid in one lump sum unless you select a settlement option as described in the payment of proceeds. So the default option is you're going to get a check, right? But if you look further into the policy, and it's not right below as it's showing here, it's on a different page. You have to go down all the way to the third option at the bottom, and so they'll pay it for a period, a specific number of years, or for life. So this type of thing is actually built into most life insurance policies. We have this ability, but we don't leverage it, and it rarely sees the light of day. So what I'm kind of proposing for situations where someone has primarily an income need for life insurance, income replacement need for life insurance, is let's get rid of the word face amount and just talk about income replacement. So what I want to kind of walk through here is, imagine that we could design a life insurance policy that's very similar to disability income. It would be similar in that we'd be paying benefits monthly. The term is expressed in years or to a specific age, in terms of how long that benefit is payable. Inflation protection can be made available. And unlike disability, which actually makes this simpler, is there's no waiting period, right? You don't have to be dead for a certain amount of period for benefits to be payable. And there's no trigger other than time passing in terms of like the benefit period for benefits to end, right? With disability insurance, if you recover from that disability, benefits cease. And here they would just be paid. So it kind of takes away a couple of those complications. Additional benefits of having a product like this is that the death benefit and the intent become much clearer to beneficiaries, right? It's income replacement. It's to replace the income to keep that going because that person isn't around anymore. There's no need for beneficiaries to manage a lump sum anymore. It simplifies the conversation and can be sold along with disability income because of the similarities and the need for income replacement during someone's working years, or it could be built into a combination product.